We've all been there. You hear a story of something amazing that's happening in an investment, you realize you have no exposure to that space, and you really do want to be part of that thrill of everything going to the moon, so you jump in only to have it sell off dramatically after you've made your purchase. This is what investors and traders call FOMO, or the fear of missing out. The idea is that you see something take off, and instead of doing your due diligence to make sure that you should be buying that investment, you just jump right on, and then you end up getting screwed because you got in near the top. And seeing how recently everyone's favorite billionaire Elon Musk just suddenly decided he no longer wanted to buy Twitter for $54.20, which caused the stock to collapse, I wanted to go into a video about what FOMO is and, more importantly, how you can avoid it. When you take a closer look at Twitter, ticker symbol TWTR, you can see from its low of 2022 to its high of 2022 was a 74.35% jump, with the vast majority of it, 38.82%, occurring between April 1st and April 5th of 2022 when Elon Musk made the announcement that he wanted to buy Twitter right out. One of the most devastating sectors for FOMO is the cannabis space. If you take a look at Canopy Growth Corporation, ticker symbol CGC, it collapsed spectacularly from its high in 2021 to its low in 2022. CGC dropped more than 95% from its high to where it's trading now. Another hugely popular sector in 2021 was space travel, and this one I have Virgin Galactic, ticker symbol SPCE. From its high to where it's trading right now, Virgin Galactic has sold off more than 87%. And to make matters worse, for all of the examples that I've provided, it's not the first time that they've done this. If you take a look at Virgin Galactic, it sold off 78.68% in 2020 before it did it again in 2021. Canopy Growth sold off nearly 85% from 2018's high all the way down to its low in 2020. So when you're talking about FOMO, it's really easy to see how you can FOMO into an asset. But what I want to talk about is how I avoid getting FOMO'd in. How do I avoid taking those epic losses? Naturally, most investors and traders will tell you that what you should do when you hear about an asset that goes up in value quickly that you want exposure to is wait. But let's be realistic about this. I know how hard it is to hear about something new or something that just exploded in value and not have any exposure to it and just sit there and watch it go higher and higher. We've all had that experience where you have a stock or Bitcoin or something that just keeps going up in value. You never buy in because you think it's going to pull back and then it never does. What I do instead of having that extreme patience that is so important is to buy in stages. However, in order to do this, you need to plan your entire investment in advance. First, you need to figure out exactly how much money you're willing to invest in this asset, and you have to be willing to lose that money entirely. I can't emphasize this enough. You need to have faith in the asset you're going to invest in, and you need to be prepared to lose all of the money that you're putting in it in its entirety. Personally, I never use leverage or options trading, and it's not because I have something against it, it's because I'm really bad at it. I can be very good at finding the right asset or investment that will work over time, but me trying to tell you exactly what time window it's going to work in doesn't work for me. By not using leverage, by not using margin, by not taking that kind of risk, I can set the amount of money that I'm willing to risk in advance and not lose any more than that amount. And I always need to be prepared to lose that money entirely. I only invest in assets or companies that I believe will succeed over the long term, but there's always the possibility that they go to zero. The only way that I can practice proper risk management is to limit my risk by limiting the amount of money that I'm willing to lose. Once I've figured out how much money I want to risk in an asset, I start with a very small quantity, and then I keep buying it as it sells off. If it never sells off to the point where I have a full allocation, then that's fine. What I have is what I have, and I'll just let it go from there and take the extra money I allocated to it and put it elsewhere. For a real example of this, we're going to take a look at the EV maker Rivian with the ticker symbol RIVN. Rivian initially came public in November of 2021, and I knew I wanted exposure to it, but I also knew that it could be extremely volatile as it was a brand new stock in an already volatile sector. So I made my first buy on November 12th, 2021 at $127. And I bought a very small quantity. Then I bought very small quantities as Rivian sold off. And you can see that I just kept buying it all the way from 2021 through 2022, with my most recent buy on May 11th of 2022 at $19.85 a share. From its high to its low, Rivian sold off more than 89%, which would be positively destructive if I had gone all in at $127 a share. However, as a result of buying in stages, I dramatically lowered my per share cost. Instead of my starting per share cost at $127 a share, I lowered it down to $59.40. That represents a reduction of 53.23% from where I initially opened the position to where I stand right now. And another key part is I still am not all in the allocation that I've set aside for Rivian. I have plenty more money that I can put to work in this position should it sell off below its $19 low. However, like I said, if it doesn't sell off, if that is the bottom, then what I have is what I have. I'm not willing to put any more money to risk unless it sells off lower than my last buy. The most important lesson you can take away from this to avoid FOMO is patience. Optimally, the best thing you can do is wait and see if the asset will sell off dramatically before you even start your position. However, you have to remember that if you take that tactic, you're often going to miss out on an investment or an asset that you want exposure to. And that's fine. You can wait for the next one, but you have to realize that you're going to miss out. Alternatively, you could take my higher risk option, which is to buy in stages. Now, of course, if I bought Rivian or anything else up high and it just went higher, I would have had a really small position, but that's fine. I can always take the money I had allocated to that position and put it elsewhere. However, if I do buy in like I did with Rivian and it sells off dramatically, that's also okay because I didn't go all in, so I don't have to take the overall epic loss that I would have if I had said this is it and put all of my money to work. I hope this video helps you out. If it did, please hit like and subscribe. It really helps me out. To learn more about long-term investing, watch some of my other videos here. Thank you for watching, and I'll see you in the next video.